There really isn't a lot of macroeconomic news scheduled in the coming week, which in some ways is lucky because the second quarter reporting season will be in full swing in America. Corporate news is coming thick and fast on this side of the Atlantic as well, so we'll largely gloss over the macro this week, other than to say that the weekly US oil inventories data due on Wednesday the 22nd of July should be as informative as ever. The last figures released by the Energy Information Administration showed US oil stocks at 539 million barrels, excluding the Strategic Petroleum Reserve. That was up 18% year on year to pretty much an all-time high, which may be one reason why crude oil isn't making too much more progress after its initial recovery from the spring collapse. To get back to the company news, well, there's a busy roster of scheduled releases here in the UK, although the Financial Conduct Authority continues to give companies extra time in which to prepare their figures and statements, so these dates remain somewhat provisional. Names and reports which may be informative for one reason or another include Minor BHP Group on Monday the 20th of July, Talk Telecom on the 21st, two more miners, Antofagasta and Fresnillo, as well as Melrose Industries on the 22nd, chemical specialist Croda, publisher Relics, software company Sage and Howden Joinery on the 23rd, and to finish off the week, Vodafone and Centrica on Friday the 24th of July. But for me, the stock that could really cause a fuss in the week ahead is food and household goods giant Unilever. It's due to release its first half results on Thursday the 23rd of July. It's 3.5 years since Kraft Heinz launched its failed cash and shares bid for Unilever at the equivalent of around £40 a share. Now, a lot's changed since then. In response, Unilever Chief Executive Paul Polman launched a programme to sharpen operational and financial performance, failed in a bid to move the firm's share listing to Amsterdam, and he then stepped down, having pretty much met the margin and growth targets that he laid down. Alan Jope has been in charge since January 2019, and he's again looking at tinkering with the legal structure, this time making London the focus. He's also aware, I would think, of how the share price is sagging back to near that £40 mark, and is some 15% or more below where it was a year ago. Now that's partly down to a weak end, by Unilever's very high standards at least, to 2019. Back in December, the company dished out a mild profit warning, noting that sales for the year were becoming below guidance, which was the lower half of its long-term 3 to 5% range. So, trading was already getting tough, and then came the pandemic. Back in April, the FTSE 100 member withdrew its sales growth and operating margin targets for 2020, after first quarter sales rose just 0.2% year on year. Even that was helped by acquisitions, as organic sales growth was exactly flat. Developed market sales rose 2.8% as Europe and America saw customers stockpiling goods, but emerging market sales fell by 1.8%, mainly thanks to lockdowns in China and India. By product, sales rose 2.4% at home care, as sales of surface cleaners like Domestos surged, surprise, surprise, but food and refreshment sales sagged 1.7%, with ice cream sales hit particularly hard. So when it comes to the first half figures, analysts will home in on three particular numbers. The first is underlying sales growth after that big fat zero in Q1. Unilever's website notes that the consensus analyst forecast for Q2 is a drop of 4.3%. Analysts will then look at the trends in key geographies and product sections that we've just outlined, and also the mix between price and volume. In Q1, an average 0.2% price drop offset volume growth of 0.2%. Second figure they'll home in on is operating profit. Former boss Paul Polman laid down a target of 20% for the underlying operating margin by the end of this calendar year, and that figure got to around 19% in 2019. For the first half, the Unilever website shows a consensus estimate of €4.7 billion in underlying operating profit for a margin of 18.8%, down by around half a point from a year ago. And the third key figure is the dividend. Despite the sales disappointment of Q1 and the scrapping of margin guidance for the year, Unilever offered reassurance that it would continue to pay and not cut dividends. It kept the Q1 distribution unchanged at €0.4104 a share, and income seekers will be hoping for more of the same. Not least as Unilever is forecast by analysts to be the 10th biggest dividend payer in the FTSE 100 in cash terms in 2020, all on its own. Now, analysts will also watch out for any broader earnings guidance, though I wouldn't expect any, especially in the context of the company's long-term goals of 3 to 5% underlying sales growth a year, that 20% underlying margin target, and strong free cash flow. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.